So, hey, Deanna, thank you for reaching out. Happy and excited to talk to you today about your venture in Costa Rica and your business. I think just to get started, maybe if you could start with just kind of the basic lay of the land, the background, like where you are now and what the plan is in Costa Rica, and then we can kind of go from there as to how I can help you and what are some of the tax things and business things you need to be looking out for.
Thanks for having me today on your podcast. I'm located in Michigan. My sister and I visited Costa Rica and we found a business that we are in the process of purchasing. We're still during the escrow or due diligence part of the business, so it hasn't closed. We have a closing date scheduled out. So the business is restaurant type of cafe in Costa Rica. We're doing all the research and we need a lot of help with the tax situation. We just don't want to do anything wrong.
Is it currently owned by Americans or is it a local business?
It is. It actually is currently owned by Canadians, and we're planning on still living in the U.S.
For now,
and
until you start going down there a lot, and then you're like, oh, I got to move to Costa Rica.
we'll probably be, going a couple times during the year to check it out and making sure everything is running smoothly. But there is someone who will be managing it down there, and of course, like we'll be doing all the remote things that need to be done, but the physical things will be done by the current staff. I believe they're trained to do that. We don't plan to move down there as of anytime soon. Maybe in the long future, who knows? We plan to still be here in the US. And their current accountant, I believe, does all their taxes on the Costa Rica side, which we're going to find out more about it during the due diligence and all of that. But I believe he's doing all of that. So, little background on the business. It's a small business. I don't remember the term where you only pay taxes on what you purchase for the business.
Are you talking about like the term for the legal entity type? Do you know, is it an SA or an SRL?
I can't remember the term, but I know it's one. It's like the best one that they do for smaller businesses that only have a handful of employees. You
Okay,
only pay taxes on what you are purchasing for the business, not the sales.
interesting. Okay, it's probably an SRL. I can talk about each one of them and how it affects the U.S.
That's all we know, and we are, as you know, we're looking for someone in the US that can help us when it comes next year around to doing our taxes, on figuring out, what do we have to do. There's just a lot of questions. We don't want to do anything wrong legally.
What I always tell people, the first step is making sure we file things correctly in the U.S. because the first step is avoiding unnecessary penalties, just
Yeah.
because the penalties for international forms are just stupid, for lack of a better word, and usually not that complicated. It's just doing it. And then how do we make sure you're structured as efficiently as possible so that you're either saving taxes or at least not paying more than you should? That's a good enough background for me to kind of give you some more information on the
Mhm.
US side at least, and then we can talk about at least what I know from the Costa Rican side. On the US, if you're going to stay here, and is this going to be connected to any current US business you have, or it's a totally different, separate thing?
No, it's a total. We're purchasing, it's called a sociedad. It's like a society thing. So the owners currently have one. They didn't want to sell it to us because I think it's tied to other businesses that they have, like Airbnb and stuff. So they told us if we could make our own, we're going to start a new one, get all the permits,
Okay, perfect.
and create our own sociedad.
This sounds like an SA, and I'm terrible at pronouncing it too, but the Sociedad starts with an A, Anonymia. And then there's also an SRL, which is like their LLC type. So basically, the SA is like our corporation in the US, and the SRL is like our LLC. And they also have a Limitada, which is similar to the LLC. And so it sounds like they don't want to sell you the stock of existing company because it
Mhm.
owns more than the restaurant itself,
Yep.
which is good for you. And this is where you have to be really careful because if you own shares in a Costa Rican SA or SRL, the
Mhm.
default in the US is that corporation is its own taxable entity to the US. So for example, if you're in the US, if you wanted to do the same thing and you set up an LLC for this business. The way that it would work is, especially if you and your sister are 50-50 owners or both owners in some capacity, it would default to a partnership, the LLC would. The income would flow through to you directly. That's how it would work. In Costa Rica, or in any foreign country for that matter, if you invest in non-US version of an LLC, it defaults to a foreign corporation. So what happens is that the income of that company is going to sit in the foreign corporation, and the general rule is you would only be taxed in the US when you take money out as a dividend or as a salary or however you do it. That can be good with the general rule, but unfortunately there are anti-deferral rules because that's the concept of deferral. So foreign corporation earns income and you don't pay tax on it as a U.S. person individually until you take it out as a dividend. That's deferral. There's anti-deferral rules, which basically have come into effect since 2017, where they end all deferral. I mean, there's very limited scenarios where, like, if you have a very asset heavy business, which this is going to have some assets in it for sure. So basically you get a return on 10% of your assets. So any income in excess of 10% of your assets, I know that's a little confusing, but it is going to be taxable currently. So you don't get to defer it, and it's taxable as ordinary income.
No matter what?
Right, no matter what. So, and you're not going to get a credit for the Costa Rican taxes paid in that scenario. It's complicated how you get there. My suggestion is, and we can look at it both ways. I mean, probably if you really want to be exact, I can kind of work out for you a model, for example, like say you earn X amount for 3 years, and we do it as that's the corporate way. And we can also make an election to treat the Costa Rican company as a flow through, like you would do generally in the US. And I can show you your tax difference one way or the other. But most likely we're going to land in the flow through scenario. That's better for you.
When you say flow through, do you mean like every year, or what do you mean?
Yeah, so in the flow through scenario, all the income and expenses flow up to your personal return.
Yep.
Just like they would in the US with a partnership. And that also means that the Costa Rican taxes paid flow up. So you get a credit in the U.S. for the taxes paid in Costa Rica. So you're equalized in that sense. So that's the flow through scenario. And that's usually the easiest and gets you to the best place. There are some scenarios where, I mean, depending on, I guess it gets a little more nuanced in the corporate scenario, seeing if that works. But I can model out both for you to see like where you get. We can just kind of nail down some assumptions.
Okay, cool.
The bad part about the corporate scenario is if you have losses on the front end, you lose the benefit of those losses. They don't flow over to the next year like a carryover loss would.
But you basically plan out the two scenarios to see what would be best?
Yeah, I'll plan it out. We would work together on, the assumptions to build out. So maybe a 3 to 5 year period. What are you expecting? And I could build out like this is what your tax would look like under both scenarios.
Okay.
The important thing is that if you set up the SA, you don't have the option of a flow through because it's treated as a per se foreign corporation. So you're stuck with corporate status. So it's critical that when you set up your new company, it's set up as an SRL. And I'm happy to be involved with your attorney down there too and look at it before you sign anything. It's basically like our incorporated company, and the IRS has said it's a corporation no matter what. So you don't have the option for the flow through with the SA. And that's where it's a little dangerous when you're purchasing from, say, a Canadian or somebody local. They don't care about all these little rules because it doesn't affect them, and they're not going to know. It's not that they don't care, they just don't know.
So you said an SRL is better than an SA.
Right. And from my experience, it makes no difference commercially, one versus the other. We can speak with your attorney to confirm that, but never been able to find any difference as far as they both offer the same liability protection. And actually the SA is just a little more complicated because you have to have like meeting minutes, and it's just a little more ordeal.
Can you say what SRL stands for? Because I think this is the first I hear about. I don't think the lawyer has said anything about this.
Sociedad de Responsabilidad Limitada, as opposed to the SA is the Sociedad Anónima.
Yeah, I'm going to have to ask the lawyer and see what was the plan to do.
For example, I talked to an attorney on Friday that has been helping Americans purchase properties in Costa Rica for over a decade, and he has always set up the SA for them, whether it's companies or real estate. They just don't know this rule, and so these people are getting stuck. So it's very common. I'm seeing less of the SAs recently just because I think the SRL is a little simpler to set up. It's very similar to in the US. Like the LLC is just very simple to set up. You don't have to have like a board of directors and all this like nuanced things like the SA does.
I'm gonna have to ask because I don't know. I know that we're working with like a legal team. Something that I learned about buying in Costa Rica is that you have to have a lawyer look and do all the process, like the due diligence part.
Yeah, their legal system is very different. They're not in a common law scenario, so it works very differently. And you have to have a lawyer actually be your notary, sign documents and things. That's step one is let's make sure of the legal entity type, just because it gives you the option. With the SA, you don't have the option. And then after that, so like I said, with the flow-through scenario, we'll get a credit for the Costa Rican taxes paid. And from there, it really just works like a... If you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. a U.S. business. That income is going to flow up to your U.S. tax return, and you have to report it just like you would in the U.S. There's an additional form you have to file depending on whether we go the corporate route or the flow-through route. The corporate route, it's a Form 5471 that's included with your U.S. return every year. Or in your case, yeah, it would be a 5471 with your return. It's like a mini corporate tax return for the foreign company. And then if it's a flow-through, it's a Form 8858, which is a little simpler to prepare every year.
The flow through option is basically all the income that we make from the cafe will be reported as income tax in our personal return.
Correct. Basically, I would work with your accountant in Costa Rica to get your annual income and expense amounts, and we'd put that on your U.S. return.
Okay. And you're saying this is typically the best scenario?
Yeah, that's generally the best scenario, which is basically, it's in the same situation as if you were investing in the U.S.
That's what I was going to ask, because I currently have a rental property, and that's what I've been doing the last 2 years.
It just flows onto your personal return.
Yep.
Exactly.
But here's the question that I have for you. What happens in this case, because my sister and I are buying the cafe together, and we each do our own personal return, tax return. So what would happen in this case? Do we just split the income completely half and half, and we each get taxed, or what happens?
What happens is, if we go the flow-through scenario, it's basically a mini partnership tax return. It's a Form 8865. So it gets prepared with your individual returns that shows 100% of the income, and then it gives you a K1, which is like partnership return gives you a K1, which is kind of like the partnership's version of a W-2, showing you your share of the income, and that's what goes on your personal return. So for example, like if you just wanted somebody like me to just do the international piece of your tax return, you already have an account in the US, I just prepare the Form 8865 that gets attached to your personal return, and then that gives your accountant K1, and they'll know what to do with the K1, and they just plug your share of the partnership information into your personal return. But
now that I'm starting to understand this a little better, so what's the main difference between the flow through and the corporate route? I guess what's the downside of doing the corporate route?
In the corporate route, like let's say for example, in the first year you have to make a bunch of investments into the company and you lose money. So let's say in the first year you lose $10,000. In that first year on your personal tax return in the US, you're going to have a Form 5471 that shows the activity of the foreign company and that $10,000 loss, but nothing is going to be on your personal tax return. That $10,000 loss is not used in calculating your income tax in the US. It's just an informational form.
Okay.
And so then the next year, let's say you make $25,000. That $25,000 is going to be taxed in Costa Rica. The way the tax calculation works in the U.S. is that actually the anti-deferral rule. So if there was deferral, you could just leave that money there and you would only pay tax if you pulled it out as a dividend, and you would pay tax on the dividend. But the way the anti-deferral rules work, and it's actually called GILTI, believe it or not, is the the acronym for the rule. It stands for Global Intangible Low Taxed Income. So what they're trying to do is they're trying to create a proxy for intangible income and make people pay tax on it today. So they say, okay, if you have a foreign corporation, we're going to look at all of its assets. And to the extent you have assets, so let's say you have assets in there of $50,000, you're allowed a return and you can defer income on 10% of that asset basis. So if you have assets of $50,000, they'll say, okay, you can have income of $5,000, but you're taxed today on the rest. So because we're assuming that must be from intangible assets. So in your case, with a $25,000 gain, you would have to pick up $20,000 in my example today as income, and you don't get a credit for the tax paid in Costa Rica because a corporation, just like in the US, there's 2 levels of tax. You pay tax at the corporate level and then on the distribution. Really, the corporation, the only time it's going to be beneficial is if you're going to be reinvesting the earnings, so you're going to get the benefit of deferral, and there's enough of an asset base to avoid that GILTI pickup. That's really the only time. If you're taking money out of the business or the income's higher than the asset base, it really doesn't make sense.
And the SRL is tied to the flow through, and the SA is for the corporate route.
Right. But the important thing is that the SRL, it also defaults to a corporation, but we can make an election to treat it as a flow-through. You do have to affirmatively elect for the SRL to be a flow-through. You have, I think, It's 75 days to make the election for the SRL from when you set it up.
And you have to do, once you set one or the other, you have to stick with that for the rest of time.
No, that's not true. They give you 5 years. You can't make another election after 5 years. If you set up the SRL and you want to elect to make it a corporation, that's pretty simple. There's no tax on that. But the other way around is tricky. If it's a corporation, you want to elect to make it a flow through, it's treated as a liquidation. So it's a deemed sale. It's really important that you do get everything set up on the front end, because what happens to me a lot is somebody calls me and says, hey, I set up this business in Costa Rica 5 years ago. It's an SRL, which is great, but we can't go back to the beginning of time to make the election. So we got to make it today, trigger a deemed sale, pay tax. Now you're on to the flow throughs. It's really very simple. I mean, I know this is super complicated.
In this case,
but it's once we get it set up on the front end and make the right election, it's really very simple going forward. It's just, it is complicated to unwind later if you do it wrong.
When do you step into the picture and start doing all the tax related stuff? Do we just contact you after we have this set up? Next year that taxes get done, that's when we talk to you? Or can we talk about it now and say, oh, like you just said, make sure it's set up as an SRL?
I say it's a two-step process. So first would be, once you've identified, I mean, you're pretty far along in this to where you've identified the business, you're going to go through due diligence, you have your attorneys. They'll draft up the paperwork. It would be good just to share what they draft up with me, just to make sure it is an SRL and we can make the election. In which case, that's really all I need to know, is that it is the right type of legal entity. And then once you get that done, you can contact me, and within 75 days of setting up the company, we just need to make that election. And technically, we even have until the filing of that year's tax return. So, if it passed, that 75 days passed, there is some relief, or we could still make it later, but it's just easier to do it early. So basically, let me make sure that it's the right type of legal entity, and then you can sign and go, and we can make the election on the US tax side. And then it's just an annual tax filing requirement. You come to me just like you do your current accountant in January, February for that year's taxes. We'd get the Costa Rican financial information, and I could prepare the international forms. The only part we didn't talk about on the international is the foreign bank accounts. So you're going to obviously need Costa Rican bank accounts for this business. The rule is there's what's called a FBAR, a foreign bank account report, and that needs to be filed annually by October. It's technically filed separately from your tax return, but you can prepare it all together and file it together. If you have Costa Rican bank accounts where in aggregate they exceed $10,000 US at any point during the year, then you need to report them on FBAR. There's no tax, it's just a reporting requirement. What I do is, come tax return time, I would send an information request for the financials of the company, and then also an organizer for basically asking for your Costa Rican bank account information and the highest value in each of them during the year. And then I can tell you if you have a requirement to file or not, and I can prepare it.
That part you said it has to be done in October?
It's technically due in October. Yeah, October 15th.
In this case, would we do it this year?
Yeah, if you buy the business today, you would have a filing requirement in October 2026. So it's based on a calendar. So basically, your 2025, your FBAR filing requirement for the calendar year 2025 is due October 2026.
Do we get to use tax write-offs for this situation?
Yeah, definitely.
What would be considered a tax write-off since we're going to be doing this?
The technical rule is ordinary and necessary business expenses. So just your typical expenses for running the business. Salaries you'd pay to people, the day-to-day operations and supplies and things like that, rent, insurance is all going to be deductible. In your case, I think the thing that's a little different that wouldn't apply to if you opened one up down the street from you in Michigan is the travel type expense. The way that travel expenses works is, as long as your trip is, the majority of the trip is for business purposes, you can deduct that percentage of the travel and stay and meals. So for example, if you're going to go down to Costa Rica for a week and you're going to spend some days with the attorneys to get things set up, some days in the business, and then you spend 2 days in Manuel Antonio at the park or something, So let's say 10 days just to make the math easier. All of your travel expense, the stay and the flights and the meals during the whole period, you could deduct 80% of that, because that's the percentage associated with the business. Meals is a little different because meals you'd get 50% of that 80%. This is one of those areas of the tax law which people play very aggressively
And
with,
we're
It's really the determination of like what's a business day and what's a personal day. And that's something I'm happy to work with you on to help you figure that out as you go. But some days it's going to be very clear, like, yeah, you went down there for this business purpose, but let's say you have a meeting one day, but the rest of the day you're just kind of hanging out. We can work on that, but if it's less than 50%, so if less than 50% of the travel is related, you really can't deduct any of the travel and stay. So the main part is making sure and documenting that the majority of the trip is for purposes of business. It gets a little trickier, I think, with people with vacation rentals because they're going down there for the vacation rental, but it's really a vacation in most cases, so that gets a little trickier. Yours will be a lot easier to figure out. So it's basic business expenses, and then the travel and stuff, you can generally expense that as well.
Since the taxes are already going to be getting done in Costa Rica based on their tax system and everything, we still have to get taxed over here for the rest of the income. Are the expenses related, like say all the food that we purchase for the cafe, that's all going to be taxed over there and we're not going to be able to deduct it over here?
I guess I don't know 100% about what you were saying about the taxing it on the things you purchase as opposed to on the net income. So we'd have to figure that out a little bit more. But we'd have to find the net income of the business. Costa Rica and the U.S. may have differences in what their taxable base is at the end of the day. So in the U.S., we're going to come up with your taxable income based on what is your revenue versus the expenses that we're able to take. Then we take that number and put it on your tax return. And then we'll look at Costa Rica and see how much tax did you pay on that same income, and we'll give you a credit for that. So in Costa Rica, we'll just have to figure out a little more like how Costa Rica is taxing it.
Yep.
I mean, my experience, I think it's a monthly filing you have to do in Costa Rica.
They told me it was like every 3 months.
Okay. Yeah, I'm sure I'm sure it depends on the industry and different things. I mean, it's a coordination effort at the end of the day, is figuring out, what are they doing in Costa Rica and making sure that we're applying the right rule in the U.S. Because at the end of the day, they have the primary taxing jurisdiction over the Costa Rican business. The U.S. has to give a credit for the taxes paid there, the income taxes at least. You can't credit like other kinds of taxes, but the income tax you can.
Going back to the tax write-offs, say we got a line of credit to be able to purchase the business down there, and we're paying this loan back. Will that count as an expense or a tax write-off or no?
The loan principal will definitely not be a tax expense, but the interest related to that loan would be a business expense.
Touching a little bit on the same subject of that loan, will my sister and I be okay if we're moving the money from a Costa Rican bank to the U.S. to pay that loan? Are there any rules or anything that we have to watch out for?
The only rule I'm aware of is that there's a $10,000 rule under the Know Your Customer rule for banks, where there is some additional paperwork the bank has to do when there's a transfer over $10,000. That's more of a question for the banker, but there's definitely no tax implication of moving the money across. It's more of a problem of exchange rate, the fees on exchanging the currency, and then I don't know of any restrictions in the U.S., but there's just going to be, the rules are going to be bank specific.
As long as we're paying our taxes, we can move our money however we want.
Yeah, for sure. The IRS doesn't care about moving money as long as you're doing the FBAR reporting, the foreign bank account reporting, and paying taxes. You can move money. There's no tax implication of moving money.
Do you have any bank recommendations since we're still in the research part?
In Costa Rica or in the U.S.?
In the U.S., like one that you would recommend that is really good with low fees or moving international money?
Yeah, I have a couple recommendations. I mean, I personally use RelayFi. It's an online bank, and I can help you get set up with that. And I'm not an international business. I have people that live outside the U.S. that work with me. There's other banks like Wise. It used to be called TransferWise. I don't know if you're familiar with that. A lot of my clients, especially like expats and people changing currencies a lot, they have lower fees on the transfer. That's one good option, is opening a Wise account, because you can deposit, it can have both currencies. You can exchange it from Costa Rican colones to US dollars within the same account. One other thing I'll mention that I forgot to was on the actual purchase of the business, it sounds like you will be purchasing the assets of the business, which I would strongly recommend that, just in case that changes for some reason, because I know for them it's not an option to buy the stock, but like let's say they set up a separate SRL for themselves to own it, and then you buy the SRL. I don't know, it could be structured in all kinds of goofy ways, but but you want the assets because if you're later to sell that business, you want a step up in basis in those assets. So if you buy the stock of the company, cost basis of the assets are the same as they were when you purchased it. So when they purchased it, would be really hard to even figure out. If you buy the assets today, let's say you buy the company for $100,000, the assets of that company are going to be worth $100,000 and that's their basis. So if you sold them tomorrow, they wouldn't be taxed because you've gotten that step up. The asset purchase is better because you're probably, if you were to sell the business later, you'd probably end up selling the assets. But that gives you more options, at least allows you to choose whether you want to sell the assets or the business later, as opposed to being kind of stuck selling the stock. The general rule is the seller wants to sell stock because it's a capital gain. The buyer wants to buy assets because you get the step up in the basis of the assets. So you kind of have this dichotomy, but you're in a good spot because they want to sell the assets too. Make sure of the legal entity type, and you're welcome to send over the legal document to me just so I can see it, or even connect me with a lawyer. And also just confirm that the deal is an asset sale. Do you have any other specific questions?
So this was all super helpful. Didn't know any of this.
If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.